Hi. On this video, I wanted to talk a little bit about assessing an area for investment. Okay, specifically baby buy-to-let. It's the sort of things that we're looking for as investors when you're going out and you're buying a property and you're investing or choosing an area to invest. This is the sort of things that people are going to want to bear in mind. And really assess and know the area inside out before they commit to actually buying a property in that area. Okay, so I've got a list of things that we're just going to quickly run through here, a little checklist. It's really important to go through upfront prior to actually buying a property, and a lot of these things you have to do, but a lot of things you can easily leave out. Okay, so in Précis, these things that you need to consider are evidence of house prices and demand in the area, the affordability of buying a property in the area, mortgages as well, mortgage affordability, demand and supply, and also economy and employment. Okay, so these will answers and around these topics will largely drive whether somewhere is a good investment area for that strategy or not. Okay, so specifically to baby buy-to-let investing. Okay, what the sort of evidence that you'd want to consider, that we need to consider when we're looking at buying these places, I call it primary evidence. So you've got data from the Bank of England, Council of Mortgage Lenders, and Land Registry. So actual sold data at Land Registry is what we're going to rely on to give us an understanding and gauge of where the market is, and what sort of prices are realistic for property in a particular area. Okay, so ways that you can access this information is on Land Registry. In the top, there is a house price section, which if you click through, you can search any street in the UK, any residential street, and it will provide the data for. That data does not always stay up, and sometimes it's there and then pulled down. So when you're looking at this data, click Command Print, save that page as PDF, and it will be there, and you'll have it to refer back to you later when you're having your property revalued. So that's where we start with the evidence. Other secondary evidence that you could look at is having a chartered surveyor come around the property and give an opinion of value. Again, that is opinion, and the best form of data is the primary evidence of sold prices that have actually been transacted upon, not agreed sales, completed on sales, in the street of a similar property, of a similar size, of a similar condition. Okay, so there's no good comparing a probate property that was bought for £60,000 to a modern family home that's just been bought for 85, because there's a huge disparity in the condition of the property, and therefore they're not comparable for the same purchase price. But we'll get there. Again, so different styles of properties. A mid-terrace property is going to be a different value to a 3-bedroom detached property. Why are they completely different? Because the 3-bed detached property is not in a row of terraces, albeit 3 bedrooms and still with a garden and all the rest of it. They are different style properties, and they are not comparable. Okay. Other services that you could use to establish the value of a property. Hometrack, they provide a report for a small fee. It's also populated. It is data driven from Land Registry, but it doesn't take into consideration the various levels of refurbishment of a property, which can mean you're at the upper end of a value or lower end of a value. It does give a gauge, which is helpful. From an affordability side, if you're just getting started, Nationwide produce a first-time buyer to house price index. Okay, first-time buyer house price to earnings ratios. Okay, so what does that mean? If the average salary of an individual who's a first-time buyer is £25,000, and the average value of a property in that region is £100,000, then the house price index will give a value or a ratio of 4.0. So 4 times gross salary is the purchase price. This helps steer steer us as investors to work out which areas are better for rental income and which areas are more likely to benefit from capital appreciation. Down in London, in the southeast, you're going to have a higher multiple. That is, the average price is going to be a higher multiple of the average first-time buyer salary. For example, in London, you might have people that average a £40,000 a year salary buying a £400,000 house, and the ratio down there is often 9 to 10. As in 10 times gross salary is the purchase price. When we're looking for buy-to-let, again, we're focusing on the smaller, lower value buy-to-let properties in the northeast, northwest, South Wales, and maybe Scotland. You are looking for a ratio of probably between 3 is the lowest, between 3 and 5, no higher than 5 really, because you're finding a much higher purchase price and mortgage costs and all the rest of it. Another thing to consider, interest rates. Where are they? Are you going for a fixed interest rate, a variable interest rate? Is it a 2-year fixed or a 3-year fixed? Have a conversation with your broker. If you don't have one, I can introduce you to them. I work closely with Trafalgar Square and Seamless Mortgages, 2 companies that I've been working with for 3 or 4 years now. Sort of price you're paying is anywhere from £300 to £500. Some take the £500 up front, some take the £300 after the mortgage, but the service is largely comparable, I would say. Interest only or capital repayment, another thing to consider that your broker can guide you through. Investors often go for interest only mortgages. Why? Because without the capital repayment element, they benefit from larger cash flow in the short term. Of course, they have a pay down plan as time progresses, but upfront they're looking to build a cash flow that grows and grows and grows. So upfront, at least, they're just opting for an interest only mortgage. But the pay down plan is something that's important. We'll come to later in further episodes. What do investors do to pay down? They can pay down smaller chunks through the life of the loan. They may do buy to sell projects, which produce larger chunks of cash, maybe 10, 20, 30,000 pounds, and they use that to pay down their debt. And also the benefit of appreciation. House prices over the long term do go up, and that debt will stay consistent. Affordability, this is something that, again, your broker will give you a guidance on, but the current stress test is gross rent must be equal or greater to 145% of the interest if the interest payment were 5.5%. Okay, so as an example, with £100,000 of borrowing at 5.5%, the interest is £5,500. The gross rent must cover that interest rate plus another 45%. So the gross interest rate, the rental coverage for a £100,000 loan, the property must rent for more than £7,975. Okay, practical next steps. So that's an overview. That's everything that you need to consider. What can I do? How can I get started? Okay, so first and foremost, we are looking for properties on streets that are selling in a modern and recently refurbished condition for between £80,000 and £100,000. Okay. How can we establish those? We go onto Rightmove, we put in the streets in these various towns in the northeast, northwest, South Wales, Scotland, and sorry, not Scotland, because house price land registry isn't on there. Oh no, it is. You're filling in these streets, and it will populate with images and maybe floor plans of the properties that have sold, and it will give the detail of the price and what date it was paid. Okay, that gives us a first steer. Okay, so we're looking on Rightmove, Zoopla, Mouseprice, auction sold lots, and we're trying to find sold evidence on those websites. Rightmove and Mouseprice are good for this, and also auction sold lots to give you a gauge of what the auctions are selling for. After doing a lot of research about employers, about bus routes, public and private investment in these towns, checking out local newspapers and reading all about that, do that for probably 3, 4, 5 towns, and you'll narrow down 2 towns that in your opinion will be the front leader, that have maybe more stock, that maybe have more investment over the next few years, or they've benefited from more investment over the last 5 years, and go with two areas, and then go and speak to every estate agent and letting agent in that town and get a gauge for which are the nice areas, which are the not so nice areas, who's working where, and where the demand is. So a very practical way of doing this: when you get to going to these properties, sorry, to these towns, and actually walking the streets and viewing these properties, you'll be able to get a gauge for the nicer streets. You literally walk in with you literally walk into the agent with a map of the town and say, can you highlight the nice streets and the not so nice streets, and you can get a gauge off that. And every agent will have a different opinion. Some will work with DSS, and some will work with blue collar, and some will have a preference for these types of people, but across the whole there will be trends. Okay, and off the back of that you can make a decision about where you are going to invest. Little practical tips on interviewing your professional team. Okay, you're going to be working closely with a builder and a project manager, so you will want to see previous work, evidence of this, pictures, videos, current work, maybe go around a site with them, testimonials from clients that they've done work for, all help build a picture of the credibility of this person, whether they are a good business relationship to get into. With agents, again, I've mentioned, so tell them about the nice streets, the not so nice streets, which houses families want to buy, which areas people want to rent, why. Something that I try to do is I get very buddy with an agent, and I say, look, I've agreed an offer. Once I've agreed an offer on a particular street, I say, look, I've agreed an offer on King Street, and I'm buying this property, but I'd like to know what other stock looks like and what it's renting for. And they'll say, oh, we've got a couple of properties on King Street. They're renting for around about £500, 550, 450, 600, whichever. And I say, oh, brilliant. Would you be able to send that brochure to me so I can look through and get a gauge for the level of specification, whether it's up here and it's very luxury, or whether it's not so much, and I know where or whereabouts I need to be, so I can give my builder a better steer on the refurb and get a better estimation of costs from that side. Other things that are definitely worth looking into, getting quite close with your local council. There will be an empty homes officer. There are sometimes grants, there are sometimes loans, there are sometimes lottery regeneration schemes going on. And ultimately, what you're looking to achieve here is a very focused buying strategy. So when you are buying, you want to be buying to a predetermined demand at a specific price point that you know works. Okay, so a couple of the numbers that I've run with in my town, the DSS, the cheaper end of town, that's £400 to £425 a month for rent. The end values are around about £65,000, £70,000. The other end of town, where it's maybe blue collar workers or professionals or working families, they're paying £580, £600 a month, but the values are closer to £110,000. So there is a disparity. It's not to say one is better than the other. Again, it's all in the purchase price. So the first property was bought for £35,000, a £12,000 renovation, and was valued up at 65 with a £52,000 mortgage, whereas other properties were bought at 65 with a £20,000 renovation to be valued at 110. So there is scope, and it's mathematic, but it's all driven by the purchase price and the level of refurb. So every case is very, very different, and a refurb of £10,000 doesn't mean that a particularly high purchase price isn't worth it. It really depends on the work. But again, focus buying, so you're buying for a particular type of tenant in a particular street with a particular specification of rent of the property to achieve the particular rent. People to note or engage with are, where are the professionals employed, where are they working, and do they have accommodation officers? So some universities, hospitals, and large companies will help house the professionals that are moving to the area to work for them. Just a little overview there on Baby Buy-to-Let basics. So again, I focused a lot there on income producing properties and those sorts of areas, and what you're looking for and questions you need answered prior to getting out to these towns. There is a lot of information online that you can have access to and make an informed decision on, and give you a good steer. But ultimately, after a period of time, you're going to need to speak to agents and get out there and view properties and have a bit of face time with agents, builders, and hopefully vendors to get in front of people that are selling particular properties. I hope that's been helpful. It's a bit of a basic crash course in Baby Buy-to-Let investing, but there'll be more to come, and this will go up on the backboard here. You can see the cash flow calculation, which I ran through this morning. That'll be going up on YouTube as well, so that'll be there for you all to refer to. Okay, thanks for tuning in, guys, and look forward to sharing the next video with you.